Dear friends, cryptocurrency has been a rising trend in the new age of information technology. With the rise of cryptocurrency, we have seen a sharp rise in people who are putting their money into crypto, most notably Bitcoin. Some people are putting dangerous amounts of their savings into Bitcoin without even doing much research on what it is. With that, we set out to explore if Bitcoin and Dogecoin, two prominent cryptocurrencies, are indeed a good investment and if the average investor should invest in it. We look at the prices during the last 2 years as our data set. The data sets we are using are extracted from the Alpha Vantage API. By using the request library, we were able to retrieve the necessary datasets from Alpha Vantage's server. We received a JSON file from the server and converted it into a pandas data frame. As we are only interested in SGD values, we dropped the USD values from the dataset. We converted the date into a datetime data type. As for the remaining columns, they are converted into floats. Now let us take a closer look at the data by visualizing them onto graphs. From these graphs, it is difficult to see if both currencies have the same tendency to spike within the same time frame. From here on, we decided to stick with one variable. We chose to go with the opening price. However, when we concatenated the two data frames, we got null values as Dogecoin has roughly 340 fewer data points compared to Bitcoin. As a result, we dropped the null values at the cost of losing precious data. In order to plot both Bitcoin and Dogecoin on the same graph, we normalized the data within the range of 0 to 1 using min-max scaler. Now, we can clearly see the relationship between the two cryptocurrencies. From this data analysis, it does not seem that Bitcoin affects the price of Dogecoin. We can see that the prices of cryptocurrencies are extremely volatile. There also isn't a solid variable that is correlated to its price. At first, we tried using logistic regression as it is used to measure the relationship between one or more variables against trending up or down of the prices. I first used the closing price and calculated the simple moving average and used the volume to count the total price for one day, using that as X, our feature. For our response variable Y, I used the difference in the price and created a variable called up-down to indicate if the price for the day increased or decreased. With the results, we can see that the accuracy score is 0.48, which is not ideal. Hence, we move on to multiple variable logistic regression. We will now fit X with open, close, high, and low, and for Y, we will use the difference between the opening and closing price to generate up-down before fitting to the regression model. With the results, we can see that the accuracy score is 0.81, which indicates that the prices are trending upwards. Moving on, we next tried to use random forests as we thought that letting the model learn from the dataset itself to and through collaboration would help. We used the closing, high, low prices and volume as the features, and the opening price was the response variable. However, this was the closest we could get the prediction to go. The mean absolute error was around 180, which meant that our prediction was off by around $180 on average. This is not the results we are looking for. One possible reason for the difference in prediction is the lack of features. Perhaps having other features such as difficulty of mining a Bitcoin might help. With the results being quite varied, we decided to try out one more model. We decided to use long short-term memory for our model because LSTM works by storing past information. The model can predict the future value based on a specific look-back window. We feel that this feature is appropriate for an extremely volatile variable which can fluctuate at any time. We are using TensorFlow and Keras libraries for the LSTM functions. To begin, we split our normalized dataset into training and test sets as usual, 80% for training data and 20% for test data. The LSTM input layer requires a 3D format of the data. As such, we have to reshape our data into the format as required by the LSTM model. The best model is chosen from the different safe models, and we'll use it to predict our test set. We realized that by tuning the batch size, choosing a lookback window of 1, and also a number of units, we can get a better root mean square error result. Therefore, smaller error from the actual value. However, we are not sure if this causes overfitting. which is something we would like to look into given more time. The results we have gotten from the various models show us that while Bitcoin is on an upward trend in the last 2 years, the price is too volatile for the average investor to buy without knowing what Bitcoin is and having some prior knowledge about the financial market. Interestingly enough, the spike we saw in the recent months were aligned with a few tweets from Elon Musk at about the same time period. Given more time, it will be interesting to look into a relationship between the tweets of Elon and the prices of Bitcoin and Dogecoin. As recent as a few days ago of the recording of this video, a tweet from Elon about Doge bucking on the moon caused the prices of Bitcoin to rise again. Having important stocks be affected by such a large extent or by the tweets of a billionaire is not a very safe bet and shows how volatile the market can be. Therefore, we do not recommend people putting in a significant portion of their assets into cryptocurrency. Here are our resources. We have all learned a lot from this project, and thank you for watching.